Welcome back to We Get Macro. We're going to continue our class about money and banking. Okay, so this is going to quick review about what we saw in our previous chapter, which is a super summary of the financial system, an introduction to it, and just reminding intermediary is somebody who stands between two parties. So in the case of financial intermediaries, they help connect borrowers and savers. Okay, and especially we're going to talk about in this class about depository institutions, which are institutions that are specialized in making loans by getting deposits from individuals and then giving loans to businesses, consumers, and so on. Okay. Also, I want to point out once again that insurance companies and pension funds are financial intermediaries, but we're not going to focus on them here because they're not depository institutions. Okay, because they don't take deposits from depositors who then make loans. They have other types of functions, and you can feel free to reach out if you want to know more about those as well. Okay, so what's the idea here? Just kind of super summarize. You can see savers have put deposits into banks, right? Which then banks use to make loans to those borrowers, okay? And how do they get paid? They get repaid by the loans with interest, right? Which tend to be higher than the interest they pay to depositors. And that's how they make profit as well, right? So this interest rate spread, the difference between the the interest paid by borrowers versus the one the banks pay to depositors, okay? This is, that's further defined three types of financial depository institutions that we're going to talk about. The first one is commercial banks. Okay, so commercial banks here, those are institutions for profit, which the interest rates on deposit accounts tend to be not so high. Okay, they're very competitive, and they tend to have high customer fees. They tend to be the size can vary a lot, but bigger banks tend to have a lot of geographic expansion. So one of the good points about these banks that they have, it's easy for you if you need money or relatively easier to find a really big bank ATM or a really big bank branch, even when you're traveling relative to other banks. Okay, so one of the reasons why they have more customer fees as well. Okay, because they're for profit. They're not too focused on just taking care of its depositors. Although this is part of their business, as they want to make sure they have depositors in hands. Right. So a couple of examples is Bank of America, Wells Fargo, MV Bank in West Virginia. Right. So all those tend to emphasize business and customer accounts, and even provide trust services, so investment services. Okay, that's a little bit different from those institutions known as savings institutions. Okay, why? They're also known as thrifts, and those institutions they're very specialized into mortgage lending. Okay, so they can either be corporations or mutual, meaning that in a corporation, a depositor is simply a depositor, right, to your client. In a mutual, a depositor also owns a share of the membership, a share of the ownership of that institution. Okay, so this highlights a lot more the importance for depositors for those types of institutions. Okay, they have to have offer low mortgage rates as well, so they're very specialized. So one example is the Fiserv company. Okay, the one that is even more completely different from not completely, but say more different from commercial banks is credit unions. Okay, because those, rather than being potentially being corporations or mutuals, this is straight up a nonprofit organization. Okay, so this is it's owned by its depositor. So if you're a depositor there, you pretty much own the bank as well. Okay, the credit union, and usually tend to be very group specific. So for example, an example is the Navy Federal Credit Union. So just people that were in the Navy can be part of it, so they can be restricted. Okay, but tend to offer lower rates on loans, like, so they prioritize loan services, and they tend to offer higher interest rates on checking account, on savings accounts, and other types of deposit accounts as well. Okay, but one negative thing, you're like, Eddie, why don't we all use credit unions? One, like I said, they can restrict. So for example, the state employees credit union, it's only for employees, state employees, right? If you work for a private firm, you can be a member of the credit union and / owner, right? So in this case, besides that, there's also the fact that they tend to be a little behind in terms of technological advancements. Okay, especially because of they're for nonprofit, so they tend to focus on taking care of its members more than prioritizing research as maybe a bigger bank will. Okay, so how can we analyze the performance of a financial institution, and specifically of a depository institution, commercial bank, savings association, or credit union? Okay, one of the ways that we can do this, and the way we're going to focus on this class, is through the balance sheet. So I'm going to introduce the concept of balance sheet to you if this is the first time that you heard about this, okay? So here there's going to be three bigger components here, which is assets, liabilities, and we're going to have the owner's equity or net worth. Okay, so the assets here are going to be things that the firm owns, that the bank owns, that is the bank's. Okay, but on the liabilities, we're going to talk about things that the bank owes, that they have to pay back. Okay, and the owner's equity or net worth in this case, it's going to be that difference between assets minus liability. Okay, and that's going to play a role in deciding whether or not a bank is doing well. So let's further understand each one of those components. So in terms of the liabilities, the main liabilities, and this is going to be, of course, simplified and summarized, because you can feel free and you can let me know if you want to take a look at one of them. I can send you a form that they have to fill out so you can take a look. But there's a lot more than just what I'm showing you guys here. Okay, so we're really simplifying everything. But the main liability is deposits, right? With interest, oh, Eddie, but deposits, I own my deposits. Exactly. You own your deposits and you leave it at the bank. You have rights over those deposits. You can come and withdraw that money upon demand, right? Well, it depends on what account you have, but if you especially have a checking account, then upon demand, you can come and take them out, right? And if that's the case, that means the bank owes you those deposits, okay? So deposit is going to be a liability for the bank, okay? So that's the most important thing. The second one is in terms of assets. We're going to go to the second part, is what the bank owns, right? And in this case, it's a little bit flipped too, right? You tend to think that loans is something that you owe people. In the case of the bank, it's actually what it owns, right? People who borrow from banks are required to pay back. So it's a loan that is from that is owned by the bank, and the payments are going to be directed towards that bank. So it's part of its assets. Okay. There's a really big problem here. Let's say I get a $1 million loan for 1 year with 5% interest rate for some reason. This is just the example I'm doing. Okay. And imagine in that case, the bank decides, I go to the bank and I get it. The bank wants to sell my loan. Can it? Yes. Like we talked about before, they can sell the loans. They will make the initial transaction fees that I have to pay to start the loan. And then if they don't want to have to deal with me as a borrower, they can sell that loan. How are we going to price that loan? That's a big question. How can we price and value each loan that is on the bank's balance sheet? Because this is really important, because we're going to actually be able to sum and quantify what are all the value of all the assets that the bank owns. Okay. And it's going to be important because we can compare with how much the bank owes and see whether or not it can actually pay for all of its debt today. Okay. So how can we evaluate loans? So take a second and try to think about this. How would we be able to value a loan even after it was made? What if it was sold 6 months later? Okay. So take a pause and try to think this through, even though I think it's a bit complicated to think, but I think it's very useful to try to understand how this market works before I give you a further explanation of it. Okay. Okay. So hope you took some time to think about this, and now we can dive more into this. Okay. So how to measure a loan? It's hard. It's hard, but it's based on the market price, right? If banks are selling these loans, there's a market for these loans, which in this case is called the secondary loan market. Okay, so the primary loan market is where the loans are made, and the secondary loan market is where the loans can be sold. Okay, so in this case, it is the price that is going for in the secondary market. So it depends on the comparability of that loan with the comparability of all other loans that are also in the market. Remember, loans can be very different from one another. It depends on who's getting the loan, right? That borrower is going to have a different risk of default, right? So there's several things that come in play, and I'll show in the next slide a little bit more of these. But it's important to say it's whatever the market is willing to pay for it. Okay, so in other words, the value of a loan, the current value of a loan can definitely change over time. Okay, and that's extremely important because that can change the value of a bank's assets, which shows everything that it owns. Okay, so like I said, banks could sell those loans to make the initial fees and then get rid of that from their balance sheet, so they don't have to deal with the borrower. And if somebody fails paying for that loan, they're not the ones dealing with the borrower. Okay, so what are some of the factors that can impact the willingness of pay of banks and institutions when they're buying loans in the secondary market? The risk of the loan. Is this loan inaccurately approved? For example, in 2007, when a bunch of people that had no income, no job, could get a mortgage, what is the risk of that loan? What is the chance I'm going to get paid back? That definitely impacts how much I'm willing to pay for that loan in the secondary market if I'm an institution, right? Also, the interest rate spread. Has the interest rate of that type of loan changed since then? That will also impact the level of the price of that loan. right? And we definitely dive a lot more into this in our money and banking class that WVU provides. So if you like this type of topic, feel free to hop into that class moving forward in your academic career. Okay, and also the reliability of the credit ratings, right? If that bank is issuing loans that are not good, and eventually it's rated as really good, like in 2007, a lot of bonds are rated as good, right? And then we saw that they were not correctly rated. So depending on the reliability of the credit ratings for those loans, that can also impact the value of the loan. Okay. Okay, so what else in terms of assets we can talk about? Besides loans and the current value of those loans in the portfolio, there's also bonds, right? They can own treasury bonds, they can own different types of bonds. And in that case, that counts as an asset as well. Why? Because when you buy a bond, right, you're giving money to somebody. In exchange, you're gonna get paid back that principal plus the interest for that bond. Okay, so it's money that the bank owns. So that bond is a right of the bank to get paid back for it. Okay. Besides that, bonds also help. Like I said, it can be done by private or government institutions. Okay, so a bank could own both. But the most important ones that tend to hold a lot, and you come in very important to be something very important in our next chapter is going to be the monetary policy chapter, in which we're going to be talking about treasury bonds and how much treasury bonds those banks own, which is one of the ways where monetary policy is implemented. Okay. Now, all this brings a question of how banks operate, which is by taking deposits and make loans. But we're going to talk about something very important a little bit and expand on it, is the ability, banks have to keep a certain amount of money in their banks, right? Because if they loan all those deposits out and I'm a depositor and I go get my money at the bank today, they won't have it, right? So they have to keep what we call reserves, which is set aside parts of those deposits to then be able to pay back its depositors, okay? And there's a level of reserve that is required to be maintained by the Federal Reserve. And all those banks that are supervised by the Federal Reserve have to follow this. Okay, it's a minimum requirement, which is 10% right now. Okay, and those requirements are going to be qualified as assets because it's something that the bank owns and uses to pay back its depositors. Okay, so an alternative to this idea of, hey, what are you telling me? You're telling me that banks don't keep all my money in there, so if all of them go get our money, I'm not going to be able to get it? That's right. Right? If you like that idea of banks not be able to loan out your deposits, you're more interested in the Chicago plan, okay, for banking industry, which would say that banks should keep all of their deposits as reserves. Okay, but just to give an idea about how the balance sheet looks before we move forward into explaining reserves in the future video, just to give you here an example. As you can see, you can have government securities, right? Those are the bonds, right? So this is the bonds that we were talking about before, right? You can see that they have required reserves. That's required by the government, but they can also hold excess reserves, right? They can hold more than what's required, but you can see the Wahoo Bank does that in this example, okay? And you can see that the total of assets just sums up the column of assets, okay? And as you can see, our deposits are considered the liabilities, right? And the net worth is simply assets minus liabilities, which in this case is 5,005K minus 4K, which is 1K. Okay, so this bank has $1,000 of net worth. So it means that if it had to pay all of its depositors back right away, you would still have money left to continue with its activities. Okay, so it would not be what we consider, it would be considered solvent. The bank can still pay for its debts. And we'll be back on the next slide, the next video, talking more about bank reserves and understanding how this entire money creation process in the banking industry works. Okay.